So I am Kristen Gunderson. I'm coming to you today. A few things that my friend Pete and I want to talk with you about. And it's the stuff that I started seeing last year. Like I started seeing credit card spending on the US going up and up and up. And I think in October of last year, credit cards were maxed out. People Inflation got so high. The spending didn't change last year. We didn't bring in enough income to be able to take on all the expenses that we were paying for. And like people are starting to default on their mortgages. I've seen that on the rise lately. And then you know, the thing with the tariffs just went into play April 2nd, and then the stock market, I saw people posted, oh, the stock market is plunging again, and I'm seeing so there's a lot of uncertainty right now with investing. So I wanted to bring Pete on, and we're just going to have a conversation about different things today. So Pete, what is your take on everything that's going on right now?
Oh, Tristan, you said that so well. Thank you. Yeah, isn't it amazing? Starting in October of last year, we started seeing people tapping out on their credit and they didn't change their spending when pricing went up, which is interesting because now we're
Yes.
seeing, right, the impact of that, which
Yes.
is, it's everything's a lag, right? Because they report after the fact. So now we're seeing that starting to hit yeah. And then Trump's been saying from day one he got in office, he's going to put tariffs into place. This wasn't new. This wasn't a
Nope,
surprise.
not a surprise. He's been
Not a
saying it for
surprise at
months.
all. So what's the market doing, right? I think it's emotional. I think the market is highly emotional right now. In fact, I read a statistic earlier that it's more emotional now than it's been,
Yeah,
which means, right? Take the emotion out,
take the emotion
right?
out.
Take the emotion out of this. So let's look at it from the aspect of what are you doing? What's the client doing for things that they can control?
Yeah. So what are some things that the client can control?
Well, that's a great question. So we know we can't control the markets. We know we can't control inflation. We can't control interest rates. We can't control, even who's in office. We can't control what they're going to do. So the things that we can control, how much do you save? How much do you spend? Where do you save it? How do you save it? Those are the basics, right? But those are the core building blocks.
Yeah. So I actually was just having this conversation with an employee this morning, because she's like, I need new glasses. I'm like, well, how much are your new glasses? She's like, $500 to $600 for the ones I want. And I'm like, well, what are you doing to save your money to make sure that you can save up to go buy your glasses? So what tips do you have for people who they just feel like they're drowning, and they can't even pay all their bills right now?
That's a real tough one because one of so the building blocks that I work off of are buckets, right? So I like to have cash reserve. I like to have a bucket of 3 to 6 months of cash reserve.
Okay.
And that's if you lose your job or business slows down or the economy, you're actually living off some of the income of the investments. And that's so you can maintain your cash flow. It's also for emergencies that kick up.
Not a super huge Dave Ramsey fan, but his baby step number one, I believe, is to build $1,000. So if you can just get $1,000, and if 1,000 is a lot, just get $500. And then once you have that, then I tell my clients, let's work up to the three, and then let's work up to the six. And it may
Right.
take a while.
Which is interesting. I'll say this because even I was talking to somebody this morning, even at a buck and a half a year income, she still doesn't have reserves.
Yeah.
And so the good news, though, is that once we look at one of the elements of the five elements of financial planning, which is cash flow, we can easily identify what she needs to remove to build the bucket up.
That is
Right.
awesome.
But
Yep.
that's where we're at. You and I were talking earlier too. Let's talk a little bit about different assets that are out there.
Yeah, because I just completely got us sidetracked. I am so sorry.
No, that's
So,
okay.
so what are the different types of assets that people can be investing in right now? I think of real estate, but I'm sure there's other ones. Like
For sure.
what's out there?
Well, let's look at it from this standpoint. Most financial advisors who get paid under assets under management, in other words, they get paid a percentage of the money that they manage. Most of them want you to invest the money in equities, which are mutual funds, stocks, bonds, mutual funds, things that they have control over, so they can get paid. Right?
Yep.
Logical. Most of them don't get paid to do real estate, but real estate is a great asset class. It has different characteristics than your traditional equity marketplace, which we're experiencing moving much different directions down right now. Let's look at crypto. Crypto is an asset class that people are all excited about. Stocks, bonds, mutual fund, crypto, real estate, different types of real estate. The thing I look at is it's all the same from a planning perspective.
Okay.
So if you're going to use real estate as your predominant investment vehicle, your asset is real estate. On the personal side, you still need 3 to 6 months cash reserve. You still
Yep.
need diversification in the real estate. You still need tax work. You still need legal work. You still need insurance work. Those are the five premises of financial
Okay.
planning. So whether it's stocks, bonds, mutual funds, real estate, crypto, I don't care. What are you doing? What are these assets doing to fulfill on the work, your personal plan? By the way, we forgot the asset class of a business.
Yeah, that's right.
I know you work with a lot of people. They own their own business. And what's the purpose of being in business?
To make money and to have freedom.
Yeah, to
And
make the money to live the life you want to live according to your plan.
yep.
Do you do this in your business as well? When you advise your clients on the CFO side, do you advise on cash flow management?
Yeah, there for the CFO side of things, when I work with my clients, there's 12 different drivers that I use, and that is one of them. And the first thing that I do is I sit down and I find out what their personal goals are. And it could be they want to put their kids through college, buy the second home, buy the convertible or the Corvette. Like everyone's goals are different, but then we assign a dollar amount to each one of those. How much do we need to send the kids to college? Do we think? How much is that extra cabin that you want to buy, the Corvette? And then I use that and come up with business goals also, but I use those numbers to figure out how much extra the business needs to generate in income in order to be able to reach their goals. And then we work backwards that way. But that's one of the reasons why I love working with you, Pete, is because you have the personal side of all my clients, and then I can come in with the business side of thing and see exactly uh, what we're missing or what we need to make happen with that business class asset.
Yeah, I appreciate that. The collaboration is king, or key, or whatever, queen, whatever you want to use. Collaboration is the right thing. As a personal advisor, and everything I do, whether the client's business owner or not, all starts with a personal plan because they're in business to live the life they want to live. And then, so I tend to know a lot of information, but I'm a fiduciary, so I'm required to know a lot of information too. But collaborating with you really helps because I know a lot going on over here, and you and I can talk at our level, peer to peer level, about what is needed over here so you can incorporate it over in that business side.
Exactly.
And it's good that you know the goals, but I like it when I can share with you really what's everything going on so that you can help drive that asset and manage that asset.
Yeah.
It's critical.
Yeah, because a lot of times the financial advisor and the tax advisor, the CPA, the bookkeeper, they don't talk to each other. So we have no idea what each other's goals are and how to make them work together to speed up the process and to make sure that they're set financially, that they can retire when they want to retire and um, have millions like
Yeah,
for
yeah.
that. They're set and they don't need to worry about their future.
So you bring up a really interesting point. That's why I like working with people who are financial delegators. Do-it-yourselfers and collaborators don't really hire me because they can do it themselves. But the delegators say, we're going to focus on what we do really well. You do your job well. Tell us what we need to do. Of course, there's some collaboration, making sure everybody's on the same page. There's some education
Yeah.
shared. But that's where the collaboration between you and I, and then the other third leg of the stool is the legal side to make sure that they're legally protected, their taxes
Yes.
are correct, their business is doing proper cash flow management, and therefore the personal then we replicate it, we do what we need to do in the personal. It's absolutely critical. Saves a client a lot of money. But here's what I
Yeah.
found. Sometimes the clients will look and go, well, between Kristen's fee and your fee and all that jazz, That seems like a lot of money. I know, but the work we're doing today, like you just said, is producing millions down the road.
Yep.
And I just funny. I just had a client I was talking to this morning. He's 49 years old, and he's been working ever since he was 17. And he just now is excited to have $5,000 reserved. He's never had $5,000 in reserves.
Wow.
And I asked him point blank, what have you been doing since 17? Well, I get the money and I go spend it. Exactly.
Yeah.
Imagine at 17 if somebody had shown him what saving 10% into savings and 10% into investment and living on the remaining 80%. Of course, there's taxes off that.
Yeah.
What if somebody showed him at 17 that formula? What do you think he'd be at today?
Well, I ran some numbers just doing 7,000 a year to put into a Roth IRA when the person, I think was 18 or 16, and it came out to like $2.2 million
And
at an
over what time frame?
8%,
Over
at an
what
8
time frame?
from like 16 to say 59 and a half when they want to
Okay,
retire,
yeah. So over 2 million at an 8% rate of return
and just seven
average.
grand a year.
Yeah, right? And
Yep.
if they have been taught that starting at 18, they're retired at 55. And it's
Hmm.
amazing how many people just get stuck in it. And that's where, sometimes I look and I go, what are you and I really doing? We're helping people have millions of dollars off into the future.
Yeah.
Right. But it takes something, it takes a discipline now to make that happen. I
Yeah.
know, I don't know if your audience is interested, but probably a little bit concerned about what to do with the market right now.
Yeah.
You're
Like, is
making
the
calls
market
yet?
even safe to invest in right now? Like, what are your thoughts on that?
Yeah, I think it is. So I'm a believer that the market's always correct, and we've seen it throughout history of the markets. There's always a correction that occurs. And markets don't like consistency, markets don't like safety, they don't like the unknown. So what they do is they go crazy and they emotionally drop because they don't know what's going to happen in the future. But every single time this has happened in the past, all of a sudden, 2, 3, 4 weeks, a month down the road, stability shows back up. The impact in this case, let's say, of the tariffs or maybe the impact of the debt ratios that are going out there will show up. It'll stabilize. And as soon as it stabilizes, the markets will take off.
Yep.
So, do I think it's safe to be in the markets? Safe is kind of a tough word, because I don't know what each person's doing. Like, so for example, if all your income is based on what's in the market, I'm a little nervous for you because your income's going to greatly fluctuate by this down. But if you've got 3 to 6 months reserves, then you ought to be able to weather
Ding,
this
ding, ding.
down.
Yep. And not take the money out while it's down. Yep.
I mean, yeah, why take the money while it's out there? Do you need to use it on the down market? It's funny. I've called every one of my clients last week, right, as the market's correcting, got everyone on the phone asking them, do you want to have a conversation about the market? And more important, the impact on your plan. Several of them said, no, you told me this was coming, so I'm good.
That's
And
great.
many of them were like, yeah, I just need a
I
little
need that
switch.
reassurance.
Yeah, I need some
Everything's going to
reassurance.
be okay again.
Yeah, exactly. And we got on the phone and I said, this is why we kept cash at 4%. This is why I asked you to build up 3 to 6 months reserves. And they got it.
Yeah.
I'm like,
Perfect.
we're gonna walk through this. You're good. And that peace of mind, you can say that peace of mind is priceless, right? But that
Yeah.
peace of mind, that calmed them right down. They knew we were at the helm taking care of it. But you do this as well, right? You got people who are in businesses, you're managing your CFO work within the business. Are you managing cash flow?
Yeah. Yeah. Exactly. One of the drivers that I look at every single month, the number of months that we have worth of expenses, like how many months worth of expenses do we have to be able to operate? Like, say the world shuts down again
Oh,
and there's no income coming in. How many months do we have? A lot of clients, when they first start, have less than a month's worth of reserves on hand. So that means they're either going to have to get some kind of loan or they're going to go out of business if the world were to shut down again. And my goal is first, like I'm watching that every single month. The goal is at first to let's get to 3 months worth of reserves and then we'll get to six. So we kind of baby step it. And
mhm.
then when we have the extra 6 months in of cash reserves in the bank, then let's go ahead and let's fully like I'd be sending them to you basically,
Sure,
Pete, of what do we do with the extra cash reserves on hand where that they can be investing this and making more money? Or
sure.
it could be that they're wanting to save for a piece of equipment or a building or something to improve their business. So
Sure. So, and let me draw a little clarification there. I'm more than happy to help businesses invest that extra cash. But I really rely the business side of things for you and there's investment advisors out there who strictly do cash management for businesses, right? I'm
yeah.
more the personal guy, so
Well, my thing is if they have that extra cash sitting there, they don't need it. So let's take it out as a draw.
okay, so
Like,
you're drawing it out and doing something with it for their plan.
yeah, put it
Got it.
into the
Yeah.
personal side of things so that they can fully fund their IRA. Uh, maybe they're putting it into their Roth or their 401k or
Sure.
brokerage, whatever
Sure. Sure. So
y'all
that's
want to
really
do.
great. That's where we have the conversation. Hey, we have this extra cash. I think it's fair for us to say, well, let's make sure the business doesn't need more cash on hand. If they're going to do a
Yeah,
capital expenditure, maybe we want to set up a line of credit with that business now that they're flush enough to get that line of
yeah,
credit. So if something happens, I got it. Maybe a business opportunity shows up out of the blue and they're like, hey, look, we need to take advantage of, doing this. So I'm a big fan of giving the companies what they need so that they can really grow. And that's where you
yeah,
do such a great
yeah.
job,
That's the collaboration. Yeah, comes
Exactly.
in again.
And then we can come back, okay, so now depending on structure, maybe we'll take some money out, draw it, however you want to do it.
Yeah,
And
because
what
they're
would
paying
that do to
taxes on it
impact?
anyways. I mean,
Yeah, exactly, right. Exactly. So let's have it over here on the personal side
yep,
and see where they can best most benefit on the personal side. Absolutely.
yeah.
I
Okay.
think if they're in crypto, which, is an asset class in my mind that most people manage independently,
Yep,
it still is. What's your cash reserve? When the markets drop, and they always do,
yep,
how are you protected yourself? Now, I will say, as far as asset classes, I'm a fan of using insurance vehicles, either life insurance or annuities,
okay,
as vehicles to manage downside risk. A lot of annuities today, a lot of life insurance today have guarantees that you can't lose when the market goes down. Now, let's be realistic. You also don't get all the upside, right? Insurance
yep.
companies aren't gonna fully protect you on the downside if they don't have some ability to capture money on the upside for themselves. I got to balance this out. But from a consumer standpoint, from my perspective as an advisor, I like having, cash reserve. We talk a lot about that. I like having life insurance that has downside protection on it. I like annuities that have downside protection on it. And then I like, equity place, a stock bond, mutual funds that have no downside protection, but greater upside. And I think if we have those buckets in place, then when stuff like this happens, and it's going to happen again, folks, when it happens, you're rest assured that your plan's going to be successful.
So you just got done really talking about how to diversify your portfolio.
That's a good point. You
Yep.
want to look at it from that big picture. Diversification is not just different brokerage accounts. I've had people come to me, well, I'm diversified. I got a Fidelity account, a Vanguard account, and this account. I'm like, they're buying the same mutual funds in each account. You're not diversified.
Yeah.
I've had people, invest with me. The custodian is one thing, but the asset managing within that custodian is fully diversified out overall. We haven't talked before, but I'll just mention here, I'm a big fan of these economic professors at University of Chicago called Fama and French.
Okay.
And they did a huge market analysis from day one of the market. They won a Nobel Peace Prize over the work that they did and created a view of the equities, a view of the stock market that is phenomenal view. And these are economic professors. They're not owning mutual fund families, right? And they say it's real simple. It's a matter of just being in the market all the time to get you the greatest gain. In fact, if you'll allow me to share the story, true
Yeah.
story. Way back when, for me in 2000, I was with the firm. We had a national convention, and for some of you out there, you may remember a mutual fund called Fidelity, but the fund called Magellan Fund. And Peter Lynch was the manager, and he at the time was the big guru of fund managers at the time. And Fidelity was on a big push to acquire clientele, and Peter Lynch came and spoke at our conference, and we were all nervous because we thought they were just trying to get in and steal our clients. How could we let the guy in the room? And he got up and spoke, and the first thing he said was, "I bet you guys think we're going to try to steal your clients." And we're like, "Yeah." And he's like, "Yeah, farthest from the truth. We need you." And now I said, "Oh, why do you need us?"
Yep.
And he said, "Look, we did an analysis on the Magellan Fund, and we found that there's two ways to get into the fund, right? There were, well, three, but the two for the consumer: the do-it-yourselfers who went in on their own, and then they had the guys who had the advisors who bought in on the fund. And they found at the time that the consumer who used the advisor had on average 5 percentage points or 5% higher return on average than the one who did it themselves. And
What does that mean number wise? Like, what's a 5%?
so on average, the do-it-yourselfer was getting a 2% rate of return,
Okay.
and the one who used advisors was getting a 7% rate of
Okay.
return. So to your
Awesome.
point of using 8% on the Roth,
Yeah.
imagine using the advisor got you closer to 7, doing it yourself got you closer to 2. That
Yep.
2.2 million you had for 30 years down the road, six, however many years down the road, far different number at 2% versus 7%, right?
Yeah.
So what he found is that they did a more research on the on why people were getting these returns, and they found that the consumer doing it themselves pulled out of the market at the wrong time and went in at the wrong time. The
Yep.
advisor, like, again, me, I'm not encouraging my clients to get out of the market by any stretch of the imagination. We knew this was coming. We had this conversation, and we're going to ride it out. We got everything else in place so that we can ride this out. Let's not let the emotion, again, of things we can't control, help, not make good decisions. And so that was fascinating to us. And again, what's the value paying an advisor to keep you in the market with the 5% differential? Now, granted, that was many years ago. It hasn't changed since. Now, I ran out to dinner just the other night, last night, and this lady came up and said, "Well, her mom, she has a Fidelity account, and her mom, they diversified her last week, and she's lost, 10 grand today, and she's wants to pull it all out." And I'm like, "Please, you're not a client of mine, but hold on,
Yeah.
let's look at the big picture here,
Yeah.
because we know you'll lose for sure if you pull it out. But
Yeah.
how is everything on the other side? Can you ride this storm out?" Back to Fama and French. Fama and French did the research, academic research as economists at University of Chicago, and their research proved the same thing as well. If you're in the market, you win. Most people get out. In
Yeah.
fact, what's interesting is they said that when the market really kicks its recovery, it really kicks up within the first week. But most people are afraid who pulled out to go back in because they don't know if this is really the kick or really is it going to be now? Is it going to be now? And they miss out the greatest gain.
Yeah.
Best thing
Exactly.
you can do, in
Just
my
stay.
opinion, as long as everything else is in order, stay with your plan. Now, if you need to call your advisor and vent, and if the emotion's showing up, I get it, do it. Be the sounding board. But stick with your plan. Collaborate with you, collaborate with the legal side, have the conversations. The greatest thing I think my clients experience, the clients we work on together, is that they know you and I have their back.
Hmm.
They know we're talking, they know we're working out what's best for them because we know how to collaborate with each other.
Exactly.
When the day is done, that's all we're worried about. Anyways, I talk too much.
I think that is a great point to just end this session on is as long as you stay with your plan and you don't pull out of the market, you'll be able to ride this wave and you will be okay. And we just need to take the emotion out of this roller coaster stock market ride right now. Um, and it's really, really important to be working with someone who can either talk you off the ledge or um, calm you in the storm.
Yeah, I think that's a great message that we'd like to say. And again, this is presuming you've got your plan in place. If you
Yeah,
don't have a plan in place, go get a plan
yeah,
and work with an advisor who knows how to truly collaborate with subject matter experts, you know,
exactly.
and that's it. Hey, Kristen, thanks so much for letting me spend some time with you again. It's always so
Yeah.
enjoyable.
Thank Thank you for joining me again. We'll continue doing this once a month. I really enjoy them. And if you haven't subscribed, go ahead and subscribe to the page. And if this was helpful to you, please go ahead and share it. And then you can book a call with us and go on from there. Thank you, everyone. See you next time.